Hello and welcome to the Forex channel. As countless traders have encountered, identifying a valid order block is merely the first step in the battle. The real challenge lies in comprehending why price doesn't consistently react as anticipated in these areas, and more crucially, how to capitalize on these situations. In this episode, we will comprehensively explore the concept of order flow and construct a trading strategy with an optimized entry model. If you've ever felt frustrated about missed profit opportunities when your identified order block didn't perform as expected, then this video is tailored for you. By the end of this video, you will acquire a firm grasp of order flow and be equipped with a potent trading strategy to enhance your decision-making and boost your profitability. So, fellow traders, if this piques your interest, kindly express your support by giving this video a thumbs up and subscribing to our channel, especially if you're new here. See you after the introduction. Thank you. Welcome back, traders. Let's dive right in. Traders often find themselves perplexed by a puzzling phenomenon. Why doesn't a seemingly perfect order block, correctly identified in the market, lead to the expected price reaction, especially when the market continues in the anticipated direction? The answer lies in comprehending order flows. While order blocks offer valuable insights, they do not guarantee price behavior. Several other factors come into play, including market sentiment, economic conditions, and supply and demand dynamics, which exert their influence on price movements. Make sure to stick around until the end of this episode, where we'll provide a comprehensive understanding of the order flow concept. Additionally, we'll introduce a trading strategy featuring an optimized entry model using order flow. This will equip you with essential insights and practical guidance for refining your trading approach. What is the precise definition of order flow? Order flow refers to areas of extreme demand or supply in which the total volume of trades being executed includes many buy and sell orders. It also includes the order block, which is a specific price level where a significant number of buy or sell orders were previously executed. By analyzing order flow, traders can detect potential market directions and identify key levels of supply and demand. Now let's explore how to identify order flows in the market. Order flow pertains to the region where buying or selling pressure accumulates before a market rally or structure breakout. Bearish order flow is identified by an area on the chart containing bullish candles, typically 2 or more, created before a sudden and substantial bearish movement to the downside. Conversely, bullish order flow is recognized as the zone housing bearish candles formed before a sharp or strong bullish movement to the upside. Traders can employ order flow zones as points of interest to spot potential entry and exit positions. For instance, the bearish order flow zone mentioned earlier can serve as an entry point for a short trade, indicating robust selling pressure in the market. Let's delve deeper into the specifics of order flow. In this example of a downtrend, we observe the price forming a low point, followed by an upward movement to gather liquidity above the existing structure. Suddenly, the price sharply drops and breaches the previous structure. The area where the price accumulated liquidity and then sharply descended from is termed the order flow zone. It signifies the last surge in buying momentum before the price drastically moves downward, breaking the previous low. It's worth noting that an order flow zone comprises a minimum of 2 candles, and we're not referring to a single candle. Within the order flow zone, we also find an order block as seen here. An order block is a more refined version of an order flow zone. Traders often wonder why the market doesn't always respect an order block, even if it aligns with their trading plan. The primary reason for price not adhering to order blocks is the presence of the order flow. Order blocks are frequently situated at the extreme end of an order flow zone, and the price can change direction before reaching the order block. It's crucial to remember that while order blocks are a valuable aspect of order flow, they should not be the sole basis for trading decisions. Continuing with our discussion, the price retraced back to what we refer to as the inducement zone. Here, it exhibited a minor pullback before making a sudden upward push. This upward movement hit the stop loss of traders who had entered the market by selling in the inducement zone. After securing the desired liquidity, the price carried on with its upward trajectory until it reached the order flow zone. At this juncture, it altered its course, moving in a downward direction and resuming its primary trend. Once more, we find an order flow zone here, denoting the final phase of buying before the price descends, creating a break of structure. At the far end of the order flow zone, we encounter an order block. This scenario underscores the observation that price tends to accord greater respect to the order flow zone compared to order blocks. It's important to emphasize that we utilize order blocks to optimize our trading strategies. They help identify an optimized zone of order flows for establishing entry points while simultaneously minimizing our stop-loss margin. This approach offers a higher reward-to-risk ratio, a critical component of successful trading. As you can see, it's relatively easy to identify these order flows. However, before we proceed, let's provide a brief explanation of the concept of inducement areas. We've covered this topic in more depth in an exclusive video on our YouTube channel, which I'll link to in the description for those interested in learning more. For now, let's offer a quick breakdown of inducement areas. In this scenario, we can observe that the price touched the upper order flow and then moved downward without breaking the recent market structure. Later, there was a minor pullback to the upside, followed by a downside move that led to a structure break. Now, we have an unmitigated order flow zone here, which has the potential to reverse the price. Additionally, there's another unmitigated zone near the break of the structure, which can sometimes confuse traders about which zone to trade, as we've discussed in previous episodes. Inducement areas are created by major financial institutions and smart money traders, such as central banks. They are designed to mislead retail traders into taking buy or sell positions in the market, ultimately generating more liquidity for the larger players. Therefore, it's crucial to be aware of these areas and understand their potential impact on the market. For a more comprehensive understanding of inducement zones, we have an exclusive video on our YouTube channel, which we will link in the description. In our perspective, this order flow signifies an inducement level. Price attempted to mitigate the upper order flow, but instead, it swiftly dropped and broke the recent market structure to the downside. This led to the creation of a fake order flow and order block. The reason this qualifies as an inducement level is that it appears that price was artificially manipulated to deceive traders and create more liquidity for significant smart money players, such as central banks and large financial institutions. Now, let's provide a quick breakdown of the bullish order flow structure. In this scenario, we can observe that the market is in an uptrend characterized by the formation of higher highs and higher lows. There's a crucial break of structure where the price breaks the previous high. This zone represents the last selling momentum before the price surges back up and forms a bullish order structure BOS by breaking the high. In this process, we identify the order flow zone. At this point, you may be inclined to wait for the price to retrace and mitigate the order block, offering you an opportunity to enter a long position. However, adopting this approach can lead to missed profitable trades because the price might not retrace and could continue its upward trajectory. Waiting for the price to return to the order block might cause you to miss other trading opportunities that arise during this time. In the following scenario, we once again encounter another BOSI. As you can see, there's an order block at the extreme point of this bullish order flow. After the price mitigates the order flow, it swiftly reverses to the upside and continues its upward movement. If we had placed a buy limit order at the order block zone, it might not have been triggered, potentially causing us to miss out on the perfect upward price movement. By waiting for the price to retrace and activate our order, we might miss the ideal price movement to the upside. Now, let's move on to examining a real chart to understand how to identify order flows. Are you ready to embark on an exciting journey into the world of online trading? Look no further than HankoTrade, your trusted partner for a seamless trading experience. Discover the power of HankoTrade and take advantage of our exclusive offer. A 100% deposit bonus when you sign up today. That's right, we're doubling your investment right from the start, giving you the edge you need in the financial markets. But that's not all. With HankaTrade, you'll have access to a user-friendly platform, cutting-edge trading tools, and a wide range of assets to choose from. Whether you're a seasoned trader or just starting, our platform caters to all levels of expertise. Don't miss out on this incredible opportunity to boost your trading potential. Click the link in the description to register now and claim your 100% deposit bonus. Join the HankaTrade community and start your journey towards financial success today. Let's take a closer look at real order flow examples on the price chart and learn how to identify them in the market. We have the Euro to Dollar 1-hour time frame chart displayed on the screen. It's important to note that you can spot order flows on any time frame. It's not limited to the time frame you choose. If you're using a higher time frame to identify order flows, you can always switch to lower time frames for entry opportunities. In the top left of the screen, we observe a break of structure. A bearish order flow refers to an area on the chart that contains bullish candles formed just before a significant bearish movement. This zone represents the last point where buying momentum was present before a sudden downward price move. Essentially, it's an area where buyers who entered the market just before the price started to drop are likely to have placed their orders, creating a potential resistance zone for the price to overcome if it wants to continue moving downward. As we shift our focus lower on the chart, we see a bearish order flow zone, created near the previously mentioned BOSI. This order flow is an inducement level created by large financial institutions like banks to deceive retail traders into entering short positions, thereby providing more liquidity for them. However, as we can see, the price did not respect this order flow zone and instead hit the stop loss of traders who had entered short positions in this area. Now, if we examine the order block of this POSS, it's evident that the price sharply moved downward without mitigating it. However, many traders were waiting for the price to retrace back up to the bearish order block to provide them an opportunity to enter the market with short positions. But as you can see, the price reversed from the order flow and moved downward without reaching the order block, contrary to their expectations. This illustrates that it's not always necessary for the price to mitigate the order blocks before moving in the opposite direction. A similar situation occurred at this point, as the market created another break of structure. The last buying momentum before the price broke the structure led to the creation of another order flow. As you can see, after reaching the order flow, the price changed its direction and moved downward. This appears to be another BOS on the chart, where the price formed a zone containing the last buying momentum candles before moving downward and creating the BOSI. We've marked it as an order flow on the chart. In another instance, we have yet another break of structure, and we can easily identify the order flow. Additionally, we can spot another order block and order flow a bit lower on the chart. However, in this case, the price did not respect the second order flow. Instead, it acted as an inducement. This is because there is an unmitigated extreme order flow just above it, and the price was likely attempting to clear the liquidity that had accumulated above it. With practice, we've become adept at spotting order flows on the chart. In the next topic, we'll explore how the order flow concept can be applied to manage a profitable trading strategy and execute trades effectively. Suppose the price has formed a bullish structure to the upside as depicted in this example. By examining this structure closely, we can easily identify the order flows within it. Our approach is to wait for the price to reach the extreme order flow on the higher time frame. Once it reaches that area, we can zoom into a lower time frame and look for a major change of character in the price action. After identifying a valid change of character, the next step is to highlight the order block generated by the chalk's wave on the lower time frame. At this stage, we can place a buy order at the highest point within the order block zone. To manage risk, our stop loss should be set a few pips below the lowest point of the zone. As for the take profit level, we have the option to target either the most recent unmitigated supply zone or the swing high. By following this trading strategy, we aim to capitalize on the bullish order flow and maximize our potential profits while effectively managing risk. Let's proceed with a real example. Here we have the Euro-Dollar 1-hour time frame chart, and we can observe the following price action. The price initially broke the recent structure to the downside, experienced a temporary rise, and subsequently reversed from the bearish order flow zone. It's noteworthy that the sell orders placed at the corresponding order block, as executed by the smart money concept traders, were not activated. Following this, the price sharply declined, creating another break of structure with 3 red candles and leaving behind a significant inefficiency. At this point, our focus should be on identifying the bearish order flow formed during the downward rally. This zone represents the last buying momentum before the price's downward movement. Having highlighted our point of interest, the next step is to patiently wait for the price to reach the order flow area. As seen on the chart, the price rapidly pushed to the upside, penetrating the order flow zone with a powerful white candle. In the next step, we zoom into the 1-minute time frame to gain more clarity and look for a major change of character. Here we have the 1-minute time frame chart, and as you can see, the price created a significant change of character by breaking the structure and leaving behind a remarkable inefficiency. Now, I'm going to highlight the order block generated by the Chach wave. Having identified our point of interest, the next step is to place our sell limit order here, adjust our stop loss a couple of pips above the highest point of the zone, and set our take profit at this swing low. Our sell limit order has been activated, and we are officially in the market. It's time to sit back and watch how things unfold. As predicted, the price moved down after the sell limit was triggered and eventually reached our take profit target by incorporating order flow analysis into our trading strategy and executing a well-defined trading plan. We entered the market at an opportune moment and captured a profitable trade. This demonstrates the effectiveness of order flow analysis in trading. Remember that trading is not just about making profits, but also about managing risks and being disciplined. It takes time and practice to become a successful trader, so don't get discouraged by losses and always keep learning and improving your skills. Keep up the good work, and I wish you all the best on your trading journey. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.